Picture two products. Each one sells for $50. One leaves you with $10 after covering its variable costs. The other leaves $20. Which one should you promote, keep in stock, and build your business around? Today you'll have a clear answer, and the math behind it is simpler than you might think. Hi, I'm Randy. Welcome back to the series on profit and pricing essentials. In our last episode, we tackled prime costs, helping you understand how much it costs to get your product or service out the door. Now we move one step closer to profit, focusing on a key financial measure that tells you whether each sale is helping your business or quietly hurting it. That measure is contribution margin, and it's one of the sharpest tools in your decision-making toolbox. No debits, no credits, just insight. Now, if you're ready, let's begin. Let's define contribution margin in plain terms. In dollar terms, contribution margin is simply sales minus variable cost. It tells you how much of each sale is left to contribute to fixed costs and eventually profit. Importantly, fixed costs like rent, salaries, and insurance do not appear in this calculation. Why it matters? Contribution margin tells you how much financial fuel each sale provides to cover your fixed overhead and eventually generate profit. If your margin is high, each sale is pulling its weight. If it's low, you might find yourself working harder but not getting ahead, like pedaling uphill on a bike with a flat tire. In fact, in businesses with razor-thin contribution margins, growing sales can actually lead to deeper losses if fixed costs aren't covered fast enough. That's why understanding this number isn't just helpful, it's essential. You may be familiar with gross margin, which also starts with sales and then subtracts cost of goods sold, or COGS. But here's the key difference. COGS often includes both variable and fixed costs, such as depreciation on equipment or salaries for production supervisors. Contribution margin, on the other hand, only removes the variable costs tied directly to each unit sold, like materials, commissions, or packaging. Use gross margin for financial reporting. Use contribution margin for product-level decisions. You sell a handmade wreath for $60. It costs $30 in materials and labor to make. So your contribution margin in dollars is $30. Your contribution margin ratio, 50%. That means half of every sale is left over to cover your fixed costs, things like rent, admin salaries, utilities, and whatever's left after that becomes your profit. Here is the scenario. You have 1,000 units sold for $100 each. Revenue is $100,000. Variable costs are $65 per unit. Contribution margin is $35 per unit, or 35%. Fixed costs are $30,000, so profit is $5,000. Now suppose variable costs decrease by $2 per unit. The contribution margin now goes to $37 per unit. Fixed costs do not change. The profit increases to $7,000. With the profit increasing by $2,000 from $5,000 to $7,000, that is an increase of 40%. What's a healthy contribution margin ratio? Well, it depends on your industry, but many product-based businesses aim for something above 30%. Service firms often achieve much higher ratios since they have little to no material cost. Think accountants, consultants, or coaches. But don't obsess over what others are doing. The real benchmark to beat is your own. Your mission is to watch your margin over time and look for ways to improve it. One of the fastest ways to improve your contribution margin is by trimming variable cost. This doesn't necessarily mean cutting corners. It means getting smarter. Review your supplier agreements and see if there's room to negotiate better pricing or perhaps volume discounts. Small changes like reducing packaging waste or optimizing shipping methods can add up quickly. Think of it as tightening the bolts on a machine. Another powerful lever is raising your prices. Even a modest 1 to 2% bump can have a big impact on your margin, especially if your variable costs stay the same. Many business owners fear price increases will scare off customers, but often customers are more price tolerant than we expect, especially if the value is clear. A strategic increase paired with a strong value message can help you earn more from every sale without needing to grow your volume. Dropping low margin products or services is another overlooked strategy. If a certain offering eats up your time and resources, but only leaves a few dollars behind, it might be time to let it go. Focus your energy on items that generate stronger returns. Every hour spent pushing a low margin item is an hour not spent building a healthier bottom line. Finally, consider promoting add-ons or extras that carry high contribution margins. Think about extended warranties, gift wrapping, or premium versions of a service that don't cost much to deliver, but command a much higher price tag. When positioned well, they don't feel like an upsell. They feel like value. There's one more reason to know your contribution margin. It's the key input to your break-even formula. To calculate how many units you need to sell to cover all your fixed costs, you simply divide fixed costs divided by contribution margin per unit. We'll walk through this math in more detail in a future episode. But now that you understand CM, you already hold the most important piece of the puzzle. Here's a challenge to get you thinking. No need to share your numbers publicly. Pick one of your top selling products or services. Take a few minutes to estimate its revenue and variable costs from last month. Now calculate the contribution margin and ask yourself, is this number higher or lower than you expected? Is this product truly worth the time and effort you're putting into it? What's one thing you could do to improve that margin? If you want to engage in the comments, just share which lever you think has the most potential in your business. A, raise prices. B, trim variable costs. C, drop low margin products. Post your letter down below. No sensitive data required. In the next episode, we'll untangle 3 commonly confused terms: gross profit, gross margin, and markup. They sound alike but mean very different things, and mixing them up can lead to pricing mistakes and reporting confusion. Be sure to subscribe and check out the playlist so you don't miss out. Well, thanks for watching, and until next time, have a great day.